Japan's financial system looks like it is on the verge of breaking, so much so that the United States just intervened. This is a chart of the Japanese yen compared to the US dollar over the last 15 years or so. You can see that from about 2015 through 2021, this relationship was relatively stable. However, over the last 6 years, it has drastically begun to deteriorate, prompting multiple rounds of intervention and players like the United States government having to come in and bail them out. So what in the world is going on here? To understand this story, we do have to take a trip back in time to learn how this all started, and this goes back to the 1990s. After a massive asset bubble crash, the Bank of Japan lowered interest rates to zero, and they're one of the first players in the world to experiment with something like this. They engaged in quantitative easing at a level that would put the Federal Reserve to shame, bought a bunch of their own government's bonds. In fact, they bought so many of them because they had an open bid saying no matter who sells at what price, we will buy as many of these as possible to maintain the peg at basically 0% interest rates. This blew up their balance sheet to the point where their balance sheet was larger than the entire GDP of their country. To put this in perspective, the Federal Reserve, which is the central bank in the United States, has a balance sheet of about $6.7 trillion right now. That's compared to the US GDP of about $32 trillion. And so to exceed US GDP on their balance sheet, the Federal Reserve would have to absorb basically almost the entire US government national debt. Now, the Bank of Japan didn't have to go that far, but they did own about half of the government bond market. And so this tight coordination between the central bank in Japan and the central government meant that the central bank was basically a money printer for the government. Anytime the government needed to borrow money, the vast majority of that was newly printed money that came straight from their central bank. Now, this created something that investors all around the world loved, and that was the ability to borrow money at 0%. You could borrow Japanese yen for basically 0% and then go do whatever you want with it. And so what a lot of investors would do, a lot of funds, they would borrow at 0%. They would then sell those yen in exchange for dollars, and then they would take those dollars and they would purchase things like US treasuries, which would pay much more than 0%. And this was the birth of what is called the Japanese yen carry trade. Again, it works in 3 steps. Number 1, borrow yen at 0%. Number 2, sell those yen for dollars, which pushes the price of the yen down compared to the price of the dollar up, and then use those dollars to purchase something like US government bonds. And then you just pocket the difference. And because this was looked at as essentially a risk-free trade, players who were using this strategy were able to leverage themselves up to their eyeballs. Now, the problem is that this is a self-reinforcing cycle. As everybody in the world starts to jump in on this trend, it makes it continue to work. It's like if everybody is buying one thing, it pushes the price up. If everybody's selling the other thing, it pushes that price down. If everybody is using leverage to do both of those things, it makes both those things work even more. That's why the carry trade worked for so long. But these things never go on forever. They have to end at some point, which means it starts to unwind. And when it unwinds and you have a lot of leverage, it can blow up quick. This right here is $100,000. I've got a box with $100,000 cash in it. All right, it's not exactly $100,000. This is just about $99,100. So if you're wondering why I have almost $100,000 in cash in a box, then you need to attend my masterclass coming up Thursday, August 20th at 7 p.m. Eastern Time. It is a free event, but I'm hosting it on Zoom, so you do have to register. And at this event, I'm going to show you a tactical way to pursue cash flow without sacrificing opportunity for big returns. During this presentation, I'm going to show you how most income strategies require you to deploy a massive amount of capital, in many cases, like $100,000 for one single position on a high quality stock, something like Costco or Eli Lilly or Goldman Sachs. And then after plopping down $100,000 on just one single position, it will allow you to produce roughly $900 worth of income off of a $100,000 position. And this is one of the most common income producing strategies out there. But instead, I'm going to show you how you can set yourself up to produce the exact same amount of income without having to deploy $100,000 worth of cash on a position. You only have to put up a fraction of the capital. Again, to be able to set yourself up to produce the exact same amount of monthly cash flow, you just have to put up far less than the typical strategy that the average person is using for producing income. In fact, this is the best cash flow producing strategy that I know. It is the one that I use most often when I'm trying to produce a high cash on cash return in my trading account. I'm going to show you everything I know about it, explain exactly how it works, and I'll give you a full breakdown of the strategy at this event. Attendance for this event is completely free. All you have to do is click on the link in the description and sign up, but spots are limited, so don't wait. If you are at all interested in learning how this high cash flow strategy works, make sure you sign up immediately so that you don't miss out on learning how to not have to deploy $100,000 worth of cash on a position. You can deploy far less to set yourself up to produce the exact same amount of income. Look forward to seeing you there. And that's why when the Federal Reserve started to hike interest rates in 2022 and in 2023, it started to blow up this yen carry trade, because all of those bonds that had been, all the US bonds that had been purchased with so much leverage, as interest rates went up, the bond prices went down. And on top of that, the fact that because of demographics and other issues in Japan, they finally started seeing inflation for the first time in years, which means they had to start hiking rates. And so not only could you no longer borrow for free anymore, but also the basis for the entire trade started to move against you. And that means all the leverage players start to unwind. All the things that they had bought started to get sold, which pushed the price down. All the things they had shorted had to get bought to close, which pushed the price up. And it made the entire trade start to unwind violently for everybody, contributing to a massive market panic. And this is why the yen has continued to collapse versus the US dollar, because the Bank of Japan can't really do much to stop this from happening. If they want to stop the yen from going down in value, they have to purchase yen. But the only way that they can purchase yen is by doing that with another currency, selling something else. The only way they can sell something else is doing something like sell US dollars. They can only do that if they raise US dollars first by doing something like selling US treasuries. This is a big deal because right now, if you look at the table of foreign holders of treasury securities, Japan is currently the largest holder of US treasuries. They currently hold about $1.1 trillion worth of treasuries. And if you look at yields on the 10-year, 20-year, and 30-year, they've been moving much higher. And the federal government of the United States does not want these things to move much higher because treasuries are the foundation of the entire global financial system. They're also the rate at which the US government has to pay if they want to borrow money, and they have to borrow money because they run constant deficits. And so it's good for nobody if treasury yields go up. So the federal government wants to do everything they can to prevent treasury yields from going up, which means they can't have big players selling US treasuries. However, the Bank of Japan is in a pickle. Their currency is collapsing. The only way to stop the currency from collapsing is to buy enough of the currency to stop the price from falling. The only way to do that is to sell the offsetting currency, in this case, the US dollar, and they don't have any of those, so they need to raise dollars by selling treasuries. Which is why, in a strange post on July 31st on X, the Treasury Secretary, Scott Bessent, said, "I look forward to seeing my longtime friend, Bank of Japan Governor Kazu Ueda, at the G20 finance ministers meetings in the beautiful Blue Ridge Mountains city of Asheville, North Carolina at the end of August. Japan's economy continues to perform well under Prime Minister Takaichi, Governor Ueda, and the Bank of Japan board, which has demonstrated a long, strong commitment to monetary and financial stability. We continue to enjoy a strong relationship and close coordination." Why in the world would he post that? Very strange, but not really, because this was a thinly veiled message that the United States, the Bank of Japan, are in this together, and the Treasury is going to do what it needs to do to make sure that there's no epic failure there. And in fact, on July 31st, the US Treasury informed banks that it may intervene in Japan's yen. He said that they should stand ready for future action. Now, just the news of potential US government intervention in this market alone was enough to cause the yen to spike relative to the dollar. Because any traders who are trying to take advantage of the situation, rightfully so, look at this and say, you know what? Somebody comes in with a bigger budget to do the opposite of what I'm doing. That could crush my trades, so I'm going to close out. But rumors of intervention alone are not enough to stop a collapsing currency. You need action, which, again, does not seem unlikely. On July 30th, the U.S. Treasury Secretary Scott Bessent was on TV saying that the yen seems very undervalued to me. He said, "We think excess volatility in the yen is not healthy." He said the yen has substantially overshot what would be called an equilibrium price. Now, this wouldn't be unprecedented for the US Treasury to get involved in propping up the yen. but it's very rare. The last time the Treasury intervened directly to prop up the yen was in 2011, and that was because of the earthquake and tsunami. However, under Scott Bessent, this would not be an unprecedented move at all. He did something very similar in Argentina. Just in 2025, he established a swap line in Argentina to prop up their peso market ahead of their elections. He gave them a $20 billion currency swap line. Now, swap lines are typically something that is established through the central bank like the Federal Reserve, but in this case, this was done directly through the Treasury. And something like this could absolutely happen again, this time with Japan, to prop up the yen. This means that Japan gets the dollars that they need without having to sell U.S. Treasuries. And by the way, this is not just going to be the U.S. Treasury. This is also extending to the Federal Reserve. Let me show you how. On August 2nd, Treasury Secretary Bessent tweeted out about the U.S.-Japan alliance, the yen undervaluation. He said that the U.S. Treasury is attentive and in close communication with his counterparts at MOF and BOJ. They will not hesitate to do further intervention. But the most important part here is that he said the FEMA repo facility is an important backstop. We would encourage it to be upsized in the coming months. The FEMA repo facility is not something that the Treasury controls. That's something that the Federal Reserve controls. And so we are seeing something like an unprecedented urging by the Treasury Secretary for the Federal Reserve to do something that usually in the past, the Federal Reserve would have said, hey, do not tell us what to do. We are independent. We make our own decisions. But that's not the way it's happening now because the Federal Reserve is under new leadership. And back in April, when Kevin Warsh was testifying before Congress, they specifically asked him about where he will draw the line on the Federal Reserve's independence. And he said he does not believe that the Fed's independence fully extends to international policy issues. Now, this question was coming because swap lines were an urgent question at the time because the Treasury had been talking about establishing a swap line with the United Arab Emirates. Treasury Secretary Bessent also said that many countries in the Persian Gulf and in Asia want swap lines. And so Senator Warren asked Kevin Warsh whether he believed the Fed could refuse a request from the Treasury to extend a swap line to a given country if the Fed needed to consult with the Treasury when opening or closing them. And in his response, he said that the Federal Reserve's independence is at its peak in the operational conduct of monetary policy. He said Fed officials are not entitled to the same special deference in areas affecting international finance, among other matters. In those matters, the Fed will work with the administration and with Congress. In other words, in areas like swap lines and international finance, Kevin Warsh is largely deferring to Congress and to the executive branch, the Treasury. So even though actions like upsizing the FEMA repo facility is something that is up to the Federal Reserve, the Fed is under new leadership now that is saying in those matters, we are going to defer to Congress and the Treasury because we don't claim independence in all areas of the things that we do. We only claim independence in the narrow area of setting monetary policy. The reality of the situation is that 3 decades of zero interest rate policy, negative interest rate policy, outright yield curve control and quantitative easing by the Bank of Japan has created a system that just cannot continue to survive as is. And the U.S. has in the past signaled that they would not get involved. Even back in January of this year, Bessent said, no, we're not going to get involved. That should attract capital on its own. The yen is at a great price right now, but that did nothing. Now it's actually threatening the US dollar. It's threatening US treasuries. And that's something that the US government doesn't want to see happen. The Bank of Japan is trapped between a rock and a hard place. They have to continue hiking, but that puts too much downward pressure on the yen, which means shenanigans like this will continue. And if it gets bad enough, something even more than just a swap line and direct intervention by the Treasury may have to happen, which could even look like the Federal Reserve stepping in, doing its own round of QE to purchase the treasuries that the Bank of Japan has to unload. I guess the only silver lining here, the good part, is that the people with the power to do something about it, the people with the power to print the money to make sure that things don't spiral into an uncontrolled deleveraging event around the world, are paying attention to this. And so while it may not be good for the purchasing power of the currency over the long term, it is definitely in the interest of any asset holders and anybody who just generally doesn't want to see a violent deleveraging or sell-off event of asset markets and financial markets around the world. But We'll see what happens. And don't forget, guys, on Thursday, August 20th, I'm going to be showing you how most people, you need to use about $100,000, that's $100,000 cash in this box, to purchase a position on something like Costco, Eli Lilly, Goldman Sachs, to be able to produce a monthly amount of income roughly equal to about $900. That's a lot of money spent to produce a very small amount of income. I'm going to be showing you at this event how to produce or set yourself up to produce the exact same amount of income with far less capital deployed than 100 grand. If you're interested in learning how that strategy works, I'm going to show you everything I know. Thursday, August 20th, 7 p.m. Eastern time. You do have to register. Spots are limited. Don't wait. Sign up now. Look forward to seeing you there. As always, thank you so much for watching. Have a great day.